Hey everyone, welcome back to Corporate Decoder. This time we're diving into a Form 10K, and trust me, the suspense is real. This isn't just about numbers, there's a merger in the works, a lawsuit brewing, and some serious financial shifts. Let's find out what's really going on behind the closed doors. This is the First of Long Island Corporation's annual report for 2024. The big news, they're getting hitched. They've agreed to merge with Connect One Bancorp, another bank. Basically, the First of Long Island is being bought by Connect One in an all-stock deal. For every share of the First of Long Island you own, you'll get 0.5175 shares of Connect One. The shareholders already approved this in February, but it still needs regulatory approval in 25. It is not all sunshine and roses though. The First of Long Island Corporation is facing a lawsuit from a customer claiming about $11.1 million in damages from a fraud. The customer claims the bank didn't do enough to prevent the loss during a wire transfer incident. Now, the numbers. Starting with the dividends, they are unchanged from 2023 at each $34 per share for the year ended December 31, 2024. Net income took a hit, falling from $26.2 million in 2023 to $17.24. That's a big drop. The bank's profits are significantly lower, meaning less money is coming in. So things are not looking so good this year. Total assets also decreased by 2.8%, settling at around $4 to $1 billion. This decrease was largely due to securities and loan drops. The bank's reserve coverage ratio remained pretty much the same at 0.88% at year end. Non-interest income increased by 22.8%. It seems that more clients are paying for their services than last year. That's a positive. Non-interest expense increased by 6.4%, and the company mentioned it was mainly due to branch consolidation and merger expenses. The report discusses things like anti-money laundering efforts and maintaining strong internal controls. It talks about legislative changes and regulatory reforms. There are many changes as well as risks around cybersecurity that could affect the business in the future. The company's cybersecurity objective is to avoid or minimize the impacts of external threat events or other efforts to penetrate, disrupt, or misuse our systems or information. To date, the corporation has not, to its knowledge, experienced an incident materially affecting or reasonably likely to materially affect the corporation. The source of the corporation's liquidity is dividends from the bank. Prior approval of the OC is required if the total of all dividends declared by a national bank in any calendar year would exceed the sum of the bank's net profits for that year and its retained net profits for the preceding 2 calendar years, less any required transfers to surplus. The corporation cannot predict whether any such legislation will be enacted, and if enacted, the effect that it or any implementing regulations would have on our financial condition or results of operations. A change in statutes, regulations, or regulatory policies applicable to the corporation could have a material effect on our business. The corporation relies on its system of internal controls and the internal controls of its TPSPs to ensure that transactions are captured, recorded, processed, and reported properly. Confidential customer information is safeguarded, and fraud by employees and persons outside the corporation is detected and prevented. The corporation's internal controls and/or those of its TPSPs may fail to comply with or override the controls, either of which could result in significant financial loss to the corporation, and/or its TPSPs may fail to comply with or override the controls, either of which could result in significant financial loss to the corporation, and/or its TPSPs may fail to comply with or override the controls, either of which could result in significant financial loss to the corporation, and/or its TPSPs may fail to comply with or override the controls, either of which could result in significant financial loss to the corporation, and/or its TPSPs may fail to comply with or override. Compared to the previous year, 2024 showed a noticeable decline in net income. Several factors contributed to this, including increased interest expenses on liabilities, increased provisions for credit losses, and a rise in non-interest expenses related to branch consolidation and the pending merger. From the analysis, a net decrease in cash income of $13.9 million for 2024 VS. 2023, 4.4 MEs was due to volume and 9.5 MEs due to rate. It shows a smaller decrease of 594 due to rates. It shows a smaller decrease of Sex Multi 93 due to volume and NSEV H&E 70 70 77 94 due to rate, and DOFB RSN 83 due to volume, and Arkin 72,593 due to volume, and R7 70774 20,000 7,083 due to volume, and Harm 55Ms due to rate. It shows a 5094 due to rate and hay. It is expected for 2025, assuming an immediate increase in interest rates of 100, 200 or 300 BPs. It could negatively impact the bank's net interest income because the bank might need to increase the rates paid on its non-maturity deposits to remain competitive. Also, the bank's securities portfolio, excluding corporate bonds and SBA agency obligations, and a large portion of its loan portfolio do not immediately reprice with changes in market rates. However, an immediate decrease in interest rates of 100, 200 or 300 BPs could positively impact the bank's net interest income for the same time period, because the bank would pay less for time deposits or borrowings that mature and reprice at a lower interest rate, and would be able to reduce non-maturity deposit rates, while the downward repricing of its assets would lag. The bank maintains an ACL in an amount believed to be adequate to absorb current expected lifetime credit losses in its loan portfolio. Because estimating the ACL is highly subjective in nature and involves a variety of estimates and assumptions that are inherently uncertain, there is the risk that management's estimate may not accurately capture probable lifetime losses in the loan portfolio. Because of risks that management's estimate may not accurately capture probable lifetime losses in the loan portfolio, it's important to note all directors and officers have different degrees of expertise to guide this business. You have a mix of finance, banking, law, and even media, which are all valuable in running a company. Each director of the corporation is required to have common stock ownership of the corporation equal to the prior 3 years of retainers. Fees for audit services continue to climb, increasing to $590,000 from $520,000 last year. From time to time, the corporation and its subsidiaries are involved in various legal actions and claims arising in the normal course of its business. In the opinion of management, these legal actions and claims are not expected to have a material adverse impact on the corporation's financial condition and results of operations. Well, after looking at the numbers of the filing, it seems the First of Long Island is in a transition. While the merger with ConnectOne offers potential for growth and efficiency, the lawsuit and recent financial performance raise some concerns. The bank is facing a lower income, and with the regulatory requirements on top of this, it makes things a bit difficult. However, they have been managing their money well, and their risk programs seem to be in shape, so we are not super worried. The deal with ConnectOne is a big turning point for First of Long Island. If all goes well, it could mean bigger and better things, but if there are regulatory holdups, or if the deal falls through, it could leave them in a tough spot. I would say it is neutral. Thanks for watching. Be sure to like, comment, and subscribe for more Corporate Decoder episodes. We would love to hear your opinion on the matter. Thanks.